It is the most powerful financial institution in the world. Its decisions ripple through global markets, determine the cost of your mortgage, and shape the fate of the entire American economy. Yet, most people don't fully understand what it is or how it works. Hello everyone, and welcome to Retro Insights, an economic historian. Today, we're pulling back the curtain on the Federal Reserve, the U.S. central bank. We'll trace its 110-year history from a crisis-born experiment to its modern-day role as the nation's primary inflation firefighter. We'll explore its powerful tools, its controversial decisions, its complicated relationship with the government, and ask the ultimate question: how effective is it really? To understand the Fed, we have to go back to a time before it existed. The early U.S. banking system was chaotic. Without a central bank, the nation was plagued by frequent panics, what we call recessions or depressions. The most famous was the Panic of 1907, which was only stopped by the personal intervention of the billionaire banker J.P. Morgan, who literally locked bankers in a room until they agreed to inject money into the system. This was a glaring problem. The U.S. economy, now a global industrial power, was relying on a private citizen to act as its lender of last resort. The answer was the Federal Reserve Act of 1913, signed by President Woodrow Wilson. Its original mission was simple but profound. 1. Provide an elastic currency, to provide liquidity to banks during crises to stop bank runs. 2. Supervise and regulate banks, to create a safer, more stable banking system. 3. Manage interest rates, to foster economic conditions that balanced growth and stability. It was a system designed for one purpose: to be the anti-panic button. So how does this mysterious institution actually fight inflation? The Fed's primary weapon is monetary policy. Think of the economy as a car. The Fed's job is to press the gas pedal or the brake to keep it from speeding into inflation or stalling into a recession. Its main brake pedal is the federal funds rate. This is the interest rate banks charge each other for overnight loans. By raising this rate, the Fed makes borrowing more expensive for everyone, from businesses taking out loans to families buying a car or a house. This cools down demand, slowing the economy and, in theory, bringing inflation down. How do they change this rate? Through open market operations. This is essentially the Fed buying and selling U.S. government bonds. To fight inflation today, they are doing quantitative tightening, QT, selling bonds to take money out of the economy, effectively reducing the money supply. It's a powerful but blunt tool, and its use has evolved dramatically over history. The Fed's history is a story of learning from its mistakes. For its first few decades, it arguably failed its first major test, tightening money during the Great Depression and making it worse. Its modern inflation-fighting doctrine was forged in the fire of the 1970s Great Inflation, where prices rose by over 13% a year. The Fed was initially timid, worried about causing unemployment. Then came Chairman Paul Volcker in 1979. He made the courageous and painful decision to drastically raise interest rates into the double digits, triggering a severe recession. But it worked. Inflation was crushed, and his success established the Fed's credibility as a serious inflation fighter. This paved the way for the Great Moderation, decades of low inflation and stable growth under chairs like Alan Greenspan. The 2008 financial crisis forced another revolution. With interest rates near zero, the Fed had no room to cut. So it invented a new tool, quantitative easing, QE, buying trillions in bonds to inject money into the economy and avoid a deflationary spiral. For over a decade, the Fed's job was less about fighting inflation and more about stoking it to a healthy level. The Fed is designed to be independent within the government, not of it. This is a critical nuance. Its leaders are appointed by the president and confirmed by the Senate, but its funding comes from its own operations, not Congress. This is meant to shield it from short-term political pressure to print money for popular programs. However, this independence is constantly tested. Presidents from Lyndon Johnson to Donald Trump have publicly criticized Fed chairs for raising rates and slowing the economy. The Fed must also constantly communicate its policy to the public and markets, a practice known as forward guidance. Today, the Fed under Chair Jerome Powell is engaged in its most aggressive inflation fight since Volcker. After initially misjudging the post-COVID inflation surge as transitory, it has raised rates at the fastest pace in history. The current initiative is a delicate balancing act: cool inflation without triggering a major recession. It's a high-wire act with the entire global economy watching. So, is the system effective? The historical record is mixed but ultimately positive. The good: the Fed has almost entirely eliminated the bank panics it was designed to stop. It successfully tamed the great inflation, and its actions in 2008 and 2020 likely prevented outright depressions. The bad: it has a history of being behind the curve, whether by being too tight in the 1930s or too loose in the 1970s and post-2020. Its tools can take 18 to 24 months to fully affect the economy, meaning it's always steering by looking in the rearview mirror. While not perfect, periods with an active Fed have generally seen longer economic expansions and less severe recessions than the periods before it existed. It is an imperfect but essential guardian of the U.S. economy. The story of the Federal Reserve is the story of modern economics itself, a relentless effort to manage the boom and bust cycle. It has evolved from a financial first responder into a sophisticated, if imperfect, manager of the world's largest economy. Its power is immense, its decisions are dissected by millions, and its success is never guaranteed. It remains, as often quoted, the only agency of government that requires both intellectual rigor and the ability to admit, "We don't know." What do you think? Has the Fed been a net positive for America? Could a different system work better? Let me know your thoughts in the comments. If you enjoyed this deep dive into economic history, please like and subscribe for more. Thanks for watching.